Imagine you are a city planner staring at a stormy coastline. You build a seawall tall enough to block out 99% of storm surge. That is your value at risk, or VAR. It is the level of protection you expect to hold most of the time, but storms can still get worse. What happens during that 1% extreme weather event? When the seawall fails, that is where expected shortfall, or ES, comes in. It tells you the average weight heights of those catastrophic waves that crash over the wall. In finance, VAR and the ES act the same way. They help us measure and prepare for the worst financial storm. In financial markets, losses follow a probability distribution, just like this bell-shaped curve. The value at risk, marked here in red, is a point where we say there is only a 5% chance we will lose more than this amount. But VAR alone doesn't tell us how bad things can get if we go past that threshold. That is where expected shortfall, shown in orange, comes in. ES looks beyond the wall, measuring the average loss in the worst case 5%. Together, VAR and ES provide a clear and concise snapshot, a single number that summarizes the total risk in portfolio. One tells you how tall the wall needs to be, the other what to expect if the storm breaches it. So, who actually uses VAR and ES? They are not just theoretical tools. They are used every single day by key players in financial world. Corporate treasurers use them to measure exposure and manage liquidity. Fund managers use them to assess and limit portfolio risk. And of course, financial institutions rely on them to meet regulatory requirements and protect themselves from catastrophic losses. Whether you are running a hedge fund or managing a corporate balance sheet, these metrics help you navigate the storm. Let's take a closer look at value at risk, or VAR. Think of a VAR like the wall protecting a castle from a flood. Except here, the flood is financial loss. The central question VAR tries to answer is, what is the maximum loss I can expect with X% confidence over the next N business days? It gives you threshold, a level of loss that should not be exceeded unless the financial equivalent of a storm surge hits. Imagine a financial analyst standing tall and confident. They look you in the eye and say, I am X% certain there will not be a loss of more than V dollar in the next N days. The number V is the value at risk, the VAR. It is the analyst's way of quantifying risk in one simple, digestible figure. And just like a storm forecast, it doesn't guarantee safety. It tells you level of protection you are likely to have. Here is how VAR is calculated in practice. We start with a probability distribution of change in portfolio's value. Then we mark a point, typically at the 5th percentile, that defines the cutoff for worst expected losses. In this case, we are 95% confident that losses will not exceed the value at this point. That is our VAR, derived directly from the shape of the risk distribution. Two critical inputs determine the value of VAR. First, the time horizon, how many days into the future we are assessing risk. And second, the confidence level, often 95% or 99%, which tells us how sure we want to be that losses will not exceed a certain amount. Together, these parameters shape the threshold for what we consider worst-case loss. Let's walk through a concrete example of value at risk. Suppose a bank reports a 10-day VAR of $20 million at 95% confidence level. This means that there is only 1% chance that the bank could lose more than 20 million over the next 10 days. In statistical terms, the 20 million is 99th percentile of the loss distribution, or equivalently, the 1% of the return distribution represented as a negative gain of $20 million. We have seen how VAR sets a threshold like the top of a cliff. But what if we fall off that cliff? That is where expected shortfall or ES comes in. Unlike VAR, which tells us the cutoff point, ES looks beyond that point and averages the losses in the worst case scenarios. In short, if the worst happens, how bad could it be? That is a critical question expected shortfall answers and why it is important in risk management. Let's go a bit deeper into what expected shortfall really means. It answers the questions: if things do get bad, how much can the company expect to lose? Mathematically, it is average loss over n days, but only in the worst case scenario. Specifically, when losses exceed the VAR. So, while VAR stops at the threshold, ES looks beyond, giving us insight into the depths of extreme risk. That is why regulators and financial institutions often prefer ES. It gives a clear picture of the tail risk. Here is a concrete example to make expected shortfall clearer. Suppose we are using 99% confidence level over 10-day horizon. The expected shortfall is average loss over those 10 days. But, and this is a key, only when losses are worse than 99% VAR. So it tells us if the market hits the tail end, that 1% case zone, what is the average damage we are likely to suffer? Both value at risk and expected shortfall rely on two key parameters: the time horizon and the confidence level. The time horizon, let's call it n days, determines how far ahead we are looking. In practice, we often calculate 1-day VAR or ES, then scale it up using the square root of time. That is why you will often see formula like n-day VAR is equal to 1-day VAR times the square root of n. And the same logic applies to expected shortfall. This scaling assumes returns are independent and identically distributed, which works in many cases, but not always during market stress. Still, this simple rule gives us a quick way to estimate risk over long horizons. One widely used method to estimate 1-day value at risk or expected shortfall is the historical simulation approach. We begin by building a database of daily movement in all relevant market variables. Then we assume what would happen today if a portfolio experienced the same percentage change as on day 1 in the historical record. Next, we repeat this process using change from day 2, day 3, and so on, effectively generating a new portfolio value for each past day scenario. This gives us an empirical distribution of outcomes from which we can extract both value at risk and expected shortfall, without assuming normality or estimating volatility directly. Let's break down how historical simulations trials are actually constructed. Imagine we have 501 days of historical data, labeled day 0 to day 500. We denote these values of portfolios variable on day I as VI. That gives us 500 overlapping intervals, each one representing a simulation trial. For each trial I, we apply the percentage return observed between day I minus 1 and day I. Today's portfolio value, V500. Mathematically, each trial estimates the next day value as V sub 500 multiplied by VI over VI minus 1. This process yields 500 simulated outcomes, forming an empirical distribution of potential portfolio values. Let's now generalize the steps of historical simulation for value at risk and expected shortfall. First, we define VI as the value of the market variable on day I. Suppose today is day N, our reference point for valuation. For each simulation trial I, we assume tomorrow's value is based on how the variable moved from day I minus 1 to day I in history. That leads to this formula. Value under the I scenario is equal to Vn multiplied by Vi over Vi minus 1. This expresses the simulated portfolio value if tomorrow's return resembled what happened on historical day I. Once we compute this for all past days, we get distribution of possible outcome, from which VAR and the ES are derived. Let's walk through a practical example. Suppose an investor based in the US holds 10 million portfolio on April 17, 2025. This portfolio is diversified across major global indices, the S&P 500 in the United States, the FTSE 100 in the United Kingdom, the CAC 400 in France, and the Nikkei 225 in Japan. Our goal is to estimate the one-day 95% value at risk or expected shortfall using historical simulation. This setup reflects a realistic scenario where market risk arises from combined movement across multiple global markets. Here is a breakdown of the portfolio composition used for the VAR and expected shortfall calculations. The investor holds 4 million in the S&P, 3 million in FTSE, 2 million in CAC, and 1 million in the Nikkei. This results in a total portfolio value of 10 million. The weight of each asset classes will help us simulate potential future portfolio value using historical percentage change in each index. We will now use this allocation as the base of the historical simulation method. Before performing the VAR and the ES calculations, we need to clarify some important assumptions about the data. First, we use total return indices, which means dividends are assumed to be reinvested in the portfolio. Second, since the investor is based in the United States, we must express all return in the US dollar. Therefore, the value of FTSE, CAC, and the Nikkei are converted into US dollar using corresponding exchange rate. These assumptions ensure consistency and realism when simulating potential loss or gain in the portfolio. To run our historical simulation for VAR and expected shortfall, we need historical index data, all converted into US dollar equivalent value. This table shows a small sample of the daily return indices for S&P, FTSE, CAC, and Nikkei. Each row represents the index value on a particular trading day. We can see that the data spans from May 15, 2023 through April 16, 2025. The vertical 3-dot row indicates that this is just an expert. The full dataset indicates hundreds of daily observations. This historical data allows us to simulate how the portfolio would have behaved under past market conditions as part of the VAR and the ES estimation process. After collecting historical data, we now generate 500 hypothetical scenarios for how portfolio might evolve on April 17, 2025, based on past market movement. Each row in this table represents a different scenario with simulated index level for S&P, FTSE, CAC, and Nikkei, as well as the resulting portfolio value and the corresponding loss. Let's walk through the first scenario as an example. The S&P 500 on April 16, 2025 was 5,275.7. On the corresponding historical data in the past, it drops from 4136.28 to 4109.9. So we apply the return to simulate tomorrow's value, and the value is indicated here. We do the same for the other indices and use those to recalculate the portfolio value using the known weights, and the result is indicated here. This results in loss of 11.7 thousand for the first scenario. We repeat this process for all 500 scenarios, which will feed into our VAR and ES calculations. Here we present selected loss value from the 500 generated scenarios. This represents how much the portfolio would lose or gain under different simulated conditions for April 17, 2025. At the top of the table, we see scenarios with large gain. For example, scenario 485 result in a gain of about 224,000, and the scenario 498 gain nearly 193,000. In contrast, at the bottom of the table are scenarios showing the worst losses. The most extreme is scenario 492, with loss of 456,483. This extreme value, especially in the tail end, are crucial for calculating value at risk and expected shortfall. Now we calculate the 1-day 99% value at risk, or VAR, based on the loss data from our 500 simulated scenarios. With a 99% confidence level, we are only concerned with the worst 1% of losses, that is, the 5 worst outcome out of 500. In this example, the 5th worst loss is approximately 235,008, which we took as our VAR. So there is only 1% chance the portfolio will lose more than this quantity in a day. To go further, we also compute the expected shortfall, or ES, which is the average loss in the worst 1% of cases. Based on our sorted losses, the expected shortfall turns out to be roughly 341,164. Here we see the empirical distribution of the simulated portfolio losses. Most losses cluster around zero, meaning the portfolio typically has small gain or loss on any given day. However, the left tail of the distribution, where the extreme loss lie, is what concerns risk manager. We have marked the 1-day 99% VAR as a vertical line near the left tail. However, the maximum expected loss under normal market conditions with 95% confidence. To the left of that line, we have highlighted the expected shortfall region. This is the average loss in the worst 1% of the scenario. Together, these measures give us fuller understanding of tail risk. However, things can get beyond our confidence limit. To assess long-term risk, we can scale our 1-day metrics to 10-day horizon. For uncorrelated return, the square root of time rule is commonly used. So, the 10-day VAR is calculated by multiplying the 1-day VAR by square root of 10. That gives us a 10-day VAR approximately 774.39K. Similarly, the 10-day expected shortfall, based on the scale 1-day ES of 319.76K, becomes approximately 1.01 million. These longer horizon metrics are essentially for understanding potential multi-day loss, especially for portfolio held over time. In the next video, I will provide full or detail of this calculation in Python code. Thank you for watching.